Welcome back to DataBytez, your number one source for data-driven content. Today we are building off the previous video I did discussing the four core financial statements, and now going deeper into the world of financial analysis with financial ratios, the investor's secret weapon. But truth be told, it really can apply to anyone from the business owner to the just if you want to, for some reason, are entranced by numbers, you want to go into accounting, you just want to learn more about this for your class, you know, all walks of life. Point is, it's about money, right? So financial ratios take the number from financial statements, those raw numbers, and turn them into actionable insights. And the fact that they are actionable is what makes financial ratios so important. So by the end of this video, you'll understand what financial ratios are, how to interpret them, and why they're essential for evaluating a company's performance, efficiency, and overall health. So not to waste too much time, let's dive straight into our lesson plan. So today, our roadmap for the day will begin with the basics. What are financial ratios? Then say why they are important, why they matter, and then dive into the four key categories of ratios, which are liquidity ratios, profitability ratios, efficiency ratios, and solvency ratios. Learning how to calculate some of the key ratios in each of these categories, because there are a lot of ratios. We'll not go through every single one, but the most important ones that we can do, and how to interpret those ratios. And then finally, we'll wrap this up with the common pitfalls to avoid when using financial ratios for analysis. So starting off, what are financial ratios? Well, ratios simplify complex financial data into actionable insights, as I've been talking about. They are calculated using data from financial statements, and they provide a framework for comparing companies, industries, or time periods. So financial ratios are like shortcuts. They take the mountains of data in financial statements and distill them into simple, meaningful, and actionable metrics. So you won't see this in a financial statement, but usually what supports them are hundreds upon thousands, who knows, even millions of individual entries into the company's general ledger. And you're taking those millions, potentially millions of entries, and putting them into a financial ratio, which you are then distilling again into a single number, which is the ratio itself. And they are financial ratios are calculated from the income statement, balance sheet, and cash flow statement. That's where these numbers are being generated from. And I think it's important that, and we'll talk about this more, but the context of industry is actually very important when discussing financial ratios. I don't want to talk about it too much, but it is important, and it's being touched upon here. So why are financial ratios important? Well, why should we care about them? And that is because they provide context. Looking at raw numbers alone, like revenue or profit, isn't enough. Ratios help us assess performance, stability, and even risk. I know we like to just think, oh, my company's profitable, that's enough. But we were touched upon that before when we were just talking about the income statement alone. Just because a company is profitable doesn't mean it is healthy, because it could be cash poor, it could be illiquid. So financial ratios are another tool we have in the toolbox to help to uncover the health of the company. They also reveal trends over time and highlight red flags, again, such as declining liquidity, increasing debt, things that might not be obvious in the raw data. And most importantly, they allow us to compare apples to apples, benchmarking one company against another or against industry norms. So this ability to compare, instead of looking at a whole statement and comparing them, we can just distill all that into individual numbers that we can just say, okay, look at which one is bigger, which one is smaller, and just go with that. So the four key categories of financial ratios. There are dozens of financial ratios, but most of them fall into one of four categories. Liquidity ratios, the measure of a company's ability to meet short-term obligations. Profitability ratios. This assess how well a company generates profit relative to revenue, assets, or equity. Efficiency ratios. These evaluate how effectively a company uses its resources, such as inventory or assets. And finally, solvency ratios. These focus on long-term financial stability and the company's ability to meet debt obligations. Are they going to be able to make their loan payments? Are they going to be able to make rent? Are the companies able to make their own rent? That is the question we are asking with solvency. So, starting off with the first one, what I love always talking about, liquidity ratios. So, making short-term obligations. So, liquidity ratios measure whether a company has enough short-term assets, enough cash essentially, to cover its short-term liabilities. Now, there are two main ratios here, the current ratio and the quick ratio. The current ratio is the most basic measure. It tells us if a company has enough assets to pay its bills in the short term. A ratio above 1 is generally considered healthy, but of course this varies by industry. That context is very important. And that formula is as it shows, current assets over current liabilities. Now the second one is the quick ratio, a stricter test because it excludes inventory. Now this might be a little bit too much, but current assets would include things like inventory. So by taking that out of current assets, as you can see in the equation, you are putting a more stringent test on the company, a more stringent burden that it must pass. And this is also called the asset test. Now, imagine a situation here. A company might have its current ratio, it might pass it, but then you realize 90% of its current assets are in inventory. So it's actually a bit illiquid, right? Liquidity is mainly a measure of cash. So taking out things that are on the hierarchy of conversion to cash. There's usually I forget what the exact hierarchy is, but it's cash is number one. Then you have something like stocks, because stocks can sell right away. And then you have something like inventory, because inventory you can sell, but you can't sell as fast as stocks. You normally have to sell that to your customers. So if customers aren't buying it, chances are you won't be able to convert that into cash. And this kind of goes on. Even things like your own furniture can be considered an asset, but people aren't typically buying your furniture. And sometimes it can be hard to evaluate how much that furniture is worth. So all of that would fall under assets. Inventory is more of a current asset because you don't expect to sit on it like your furniture would maybe for 10 years or something like that. You expect to sell it within the year. For some reason, I want to say sell is shell, but you'd want to sell it. And so taking that out of your current assets puts a more strict ability to measure a company's ability to pay its bills, because you're taking out something a little bit more of that less convertible asset from the equation. So going on to profitability ratios, measuring profit generation. So profitability ratios show you how well a company is turning revenue into profit. So we have the gross profit margin, which is revenue minus COGS divided by revenue. The gross profit margin tells us how much profit is left after covering the cost of goods sold. The net profit margin goes a step further, showing what's left after all expenses, taxes, and interest. And finally, return on equity, or ROE, measures how effectively the company is using shareholder investments to generate profit. All of these are important. I think in my life, more so than anything, it's the net profit margin that people usually ask about, at least for me. Of course, that can always vary by people, what our people are interested in, what the stakeholders are interested in. But net profit margin. Oh, and I think I made a mistake here on return on equity. I said net income plus shareholders' equity, net income over shareholders' equity. So all these tell a tale. Probably net profit margin. Well, here, return on equity would be something if you are investing in a company, you want to know how much your investment is actually being used for. This is something that I think in particular OpenAI should be concerned about, because people are throwing billions of dollars into that company and they cannot turn a profit. So their net income is negative and their shareholder equity is very high because people are throwing in billions. So return on equity there is very bad. Very, very bad. It'd probably make you run away, at least if you had some sense. But Wall Street never really has sense. People just throw money at, like, throwing money at things. So going on to efficiency, the efficiency ratios, resource optimization. So efficiency ratios focus on how well a company uses its resources. Who would have thought? So we have two main ratios here: inventory turnover. That's a tongue twister for me. Which measures how quickly a company sells its inventory. A higher turnover rate indicates efficiency, but can also signal potential stock shortages, which is what I was talking about earlier when it comes to the liquidity ratios. How fast can a company turn its inventory into cash? A healthy company should be able to turn its inventory faster to have a healthy turnover. A high turnover can be a good problem to have. This is something I would say would be like for the Wii, not the Wii, the Switch. There we go. I'm thinking the wrong generations here. Aging myself here. The Switch, for a period of time, was hard to find, but I don't think, at least not like the PlayStation 5, it was due to manufacturing problems, not of a lack of access to chips. It was more just people kept buying that stuff. It was too fast. So potentially an inventory shortage can be a good sign. Can be a sign of, a very ecstatic consumer base, or it could be a problem where you're not able to service your customers because of other reasons. And then we have asset turnover, which measures how efficiently a company uses its assets to generate revenue. It's especially useful for asset-heavy industries like manufacturing, which need tons of capital investment into machines in order to even produce anything. This is very big in chip manufacturing, funny enough, as building off that chip, because the tooling to build chips is very, very expensive. Equally important would be something like rare earth metal processing, where the infrastructure needed to process the rare earth metals is very, very specialized and expensive. So again, inventory turnover. How good is a company at taking its inventory and turning it into and selling it, turning it into cash? That is COGS divided by average inventory. And then asset turnover. How efficiently a company uses its assets to generate revenue, which is revenue divided by average total assets. Now, solvency ratios, long-term stability. Debt to equity ratio shows the proportion of debt to equity. A lower ratio is generally better, as it indicates less reliance on borrowed funds. Actually not relying on just all of other people's money. The interest coverage ratio tells us if a company can meet its interest payments. A ratio below 1 is a red flag. It suggests the company doesn't earn enough to cover its debt obligations. Now, this is actually pretty important when considering the current landscape we are in now, where the Fed has raised interest rates to the highest level they've been to in decades, right? We've been living in this higher interest rate environment. This was a pretty big problem for the tech industry. Now, kind of like how, going back to OpenAI, not to bully them or talk about their poor financials or anything like that, but in the tech space in general, people will throw money, venture capitalists, private investors, angel investors, whatever, will throw money at tech because they believe it will eventually turn a profit, because the returns on a successful tech venture are enormous. Why? Because it operates on nearly 100% margin. You don't need to get materials to ship out and all this. It's software, right? You can reproduce it infinitely. That is not something you can do with physical products. You cannot just take like for example, a phone and just Control C, Control V, and all of a sudden, oh, I have a second phone. No, you need to take it to a processing plant. You need to source materials, plastics, metals. You need to use specialized tools to put it all together. You don't need that with software. So companies would take on massive amount of debt in our low interest rate period, and in the hopes that eventually you'll have these very profitable tech companies, and they operate on often variable rate loans. And so as the Fed decides to raise rates, all of a sudden these businesses can no longer service their debt, and now they are become insolvent. And that is what a lot of things happen at the start of this high interest environment. All of a sudden the interest became too much. So looking at the coverage ratio in particular, you might be wondering what this EBIT divided by interest expense is. Well, EBIT stands for earnings before interest and taxes. This is part of a larger acronym. There's a bunch of acronyms in a money world, finance world. EBITDA, which is in earnings before interest, taxes, and amortization. If you operate in business long enough, you will, I'm sure, hear something about EBIT and EBITDA. And when it comes to debt to equity ratios, that is just our total liabilities divided by our shareholder equity interest, which is how much, what is the position of the owners? How much money have they put into the business? So now that we've covered the core categories of the financial ratios and some of the most commonly used ratios within each of those categories, we can now move on and discuss how to read and interpret ratios. And that goes down to compare, look, and use. You want to compare ratios against industry benchmarks. Again, it's important to note that what is good in one industry might be bad in another. The next one is looking for trends over time. Just like financial statements, you are not just looking at a particular year. You're looking at multiple years. You're looking for trends. It's not just a single snapshot, not a single year. In order to make your decisions, you need to really do your research. And then you want to use multiple ratios for a well-rounded analysis. Just like you wouldn't just look at one financial statement, you wouldn't just use one ratio. You would use a suite of ratios in order to decide whether a company is healthy, attractive for investment, or whatever have you. You wouldn't just use one. Now, common pitfalls to avoid. Now, it's easy to get lost in the weeds when analyzing ratios, but avoid over-analyzing small fluctuations. Do not make, what is the expression? A mountain out of an anthill? I might be saying that wrong, but these are small fluctuations are often noise, not signals. Noise in data is a problem for us as human beings, just as it is for machine learning models. And that could be a fun discussion one day to have, what noise is in data. But I think this is a little bit outside the scope for today. But point is, you want to be sure you are looking at the true trend and not just a small fluctuation. Again, the example I go back to, a quarter is underperforming. Not really a big deal. Some flighty investors might be like, oh my God, for the first time, I think, for instance, like Facebook, I think that comes to mind. The first time Facebook reported it did not grow its user base, people started freaking out like, oh my God, this is the decline of Facebook. Oh my God, this is the end of times. We should sell Facebook now, sell Meta. It's going downhill. Just the first time it's bound to happen. For the first, it's bound for some people might leave the platform more than people are registering in. But that doesn't necessarily mean the trend is now going into complete descent. You need more time to do that. Now, ignoring industry context, I keep harping on this. What is good in one industry might be bad on another. Now, for instance, going back to tech, just because we're kind of discussing that previously, some debt to equity ratios might seem very unattractive in something like public utilities. I don't necessarily know, but just play along with me. Something like a utility company might have too much debt, but you go to a tech company, as we say, they were just taking on debt with the hopes. It might be unattractive in public utilities, might make much more sense in tech. Context is everything when it comes to looking at financial ratios, so being able to understand your specific industry's needs is important. And then again, focusing on one ratio while ignoring the others. You do not just want to rely on one ratio for your analysis. You want to be able to look at multiple ratios. Now again, why financial ratios matter? Well, that comes back down to, I sound like a broken record at this point, but actionable insights for investors and managers. Financial ratios also allow to highlight strengths and weaknesses, and they just drive better decisions. Because again, if you want to make a decision, you do not want to drown in details. You do not need so much granularity, as the data person to me says. You do not need all of that. You want to distill that down into a core metric that you can act on. So this is where financial ratios play a key role. And ultimately, it just allows for better and faster decision making by helping you be quick about it. You want to not waste time poring over things because business requires fast action. Oftentimes, you cannot just wait around and taking as much time as you need, and you just need to act. And so having these tools at your disposal is critical in that. So in closing, we finally reached the end here. Financial ratios are tools for understanding performance, efficiency, and stability. They build on the financial statements we previously covered. And you should use them wisely to make data-driven decisions. By using these ratios wisely, By using these ratios wisely, you'll be better equipped to make data-driven decisions, whether you're investing, managing a business, or evaluating a company. Next time, we will be talking about the single most important document you must read before you even think about investing a single penny in a company. No joke. It's very important, and you do not want to miss it. So, as always, it's been Patrick from DataBytez. Until the next time, stay data-driven, my friends. Have a great rest of your day. Toodles.